sales factor, as well as the market-based sourcing. The lawsuit says that it violated some various provisions of the California Constitution, the single subject rule. If you remember, it was a while ago, but it was they used the money to do green projects. They provided special rules for certain cable companies and said, we're going to use market-based sourcing. So the challenge is that's not a single subject. They lost in trial at the trial court, and it's going to the Court of Appeals. It would be a huge shift if this happened. It would shake things up quite a bit. So we'll see what happens there. Another thing to be aware of is sometimes you look at the rules, you follow all the apportionment rules, and gee, it just doesn't seem like it's fair. It doesn't seem right. Perhaps there's multiple taxation. Perhaps the rules just don't account for certain facts. Well, that's what 25-137 is for. That's in California. Every state has their own version, as well as UDIPTA, which is sort of like a, hey, you know what? These rules aren't working. They're not fairly representing the business activities in the state. So then we can ask for a different method. Whoever's asking, and the Franchise Tax Board might ask as well, they have the burden of proving that the regular formula doesn't work properly and that whatever their proposed alternative is reasonable. And I'll give you a quick example of when this happened was for sales factor purposes, there was this Microsoft case, and they bought and sold securities as a way to deal with their treasury function. But that as a result, they had all these sales which happened, which weren't software sales, but they were counted as sales. And since all those sales were sourced outside of California, it dramatically reduced their sales factor. And the FTB applied 25-137. The Supreme Court took the Microsoft case and found, yeah, this is a good example using the facts of that case to show the regular rules don't work, and required the Microsoft to take out the treasury function sales to just use the sales from their regular software business. So now getting to the heart of the matter here, the market-based sourcing rules are provided in our Revenue Tax Code 25-137. And the big ones, so there's a couple others listed here, but the big ones are sales from services. Sales from services are where the benefit of the service was received. So you had to look at the purchaser. Where is the purchaser, and where did the purchaser receive the benefit of the service? The other big area is sales from intangible property, and they're sourced to the extent the property is used in the state. So here's the statute. We've got these very few words that need to be interpreted, and it has created sort of a monster with the regulations that have been written, rewritten, and worked on, and continuing to be worked on since the get-go back in 2011. And they're still working on it. They're still changing things. And a little history about how this reg happens was, so the legislation before Prop 39 came out in 2011 saying, hey, we've got this market-based sourcing rules and elective single sales factor. It kind of came out of the blue. FTB wasn't ready for it, and they needed regulations to figure out, well, how do we do this market-based sourcing? So it was kind of a quick job, and they put together something as fast as they could just to give folks the ability to file their returns and have some sort of rules. So they promulgated those, and then immediately opened another. They had interested parties meetings to develop regulations, and they immediately opened another one, and then eventually did some amendments on very specific issues that they could address. But they knew that they weren't addressing all of them, and so they amended the reg in 2017 to address how you source sales of marketable securities, special rules for securities dealers, sales of interest in business entities, interest, goodwill, and asset management fees. These special rules try and reflect to the market. Where should these sales be sourced? We have to look to the market. So even before these were finalized, they were amending again, and they continue to be amending. They had 6 interested parties meetings. So they've had proposed amendments. The FTB needs to ask the actual Franchise Tax Board. FTB staff has to ask them for permission to go to a formal regulatory process, and they did that back in June of 2021, but we haven't seen any final regulations or any other interested parties meetings or any other changes since then. So we do have some proposals, and the current draft of the proposal would provide that the amendments are applied. Essentially, it'll be, their plan is to apply it prospective only, which is another kind of a puzzling question. If they're coming up with better rules, one might wonder, hey, isn't it reflecting the statute better if I get to apply this retroactively? They actually allowed retroactive application in the first regulation, and at least for now, they're saying no, but I think there will be a lot of pushback on that. So the regulation, it's 25-136-2, mainly assigning receipts from services as well as intangible property. So the way the regulation works, it applies a set of cascading rules. And those cascading rules basically look to, the cascading rules is a very confusing regulation. And they apply cascading rules differently depending on the type of service or the type of intangible property. But generally, the first rule is, let's look at the books and records of the taxpayer or the contract to see where the benefit of the service is received or where the intangible property is used. Very difficult to apply. There's no examples where it would say, hey, here's a case where you could apply this rule, because the books and records don't always say where a benefit of the service is received. Now, the current regulations, and this was sort of done as a way of convenience, say, okay, we're going to distinguish sales of services to individuals versus those to corporations. The billing address seems like a really simple, easy, administrable way to source the sale. Where's the customer? Let's just go billing address. This will be nice and easy. So they did that, and that's currently what's in the reg, but their proposals get rid of this rule actually and replace it with other rules. But this is not something that can be applied for corporations. And these are just sort of the cascading rules. There's the billing address one. And then so they, again, trying to make it simple, but if there's something that's just way off, like your billing address is in one state, but all the work's being done somewhere else, FTB is not stuck with it and taxpayer is not stuck with it. You can change it if you can show with your books and records or some other evidence that that's just not right. And reasonable approximation is also a kind of a fail-safe that oftentimes both individuals and mainly corporations end up falling into, and there just simply aren't rules to apply. Now let's go to the services to businesses. And here, FTB just was not comfortable with the default first rule being billing address. So we're going to look to the benefit of the service based on what's in the contract or books and records. Oftentimes that's not very helpful. So then what can you do if these things aren't showing where the benefit of the service is or where the benefit of the service is? So we can look to and reasonably approximate. Now this is kind of sort of open-ended in a way, and how you reasonably approximate. You can kind of like look to your facts, your special circumstances, and come up with a method that is reasonable. Now, if you can't, if there's no way to even reasonably approximate, then the next rule says, where did the customer place the order from? And finally, where's the billing address if you can't figure that, where the customer applied the order from? Reasonably approximated. So this, most of the time I see it and there where, geez, the rules are just really not helping us out at all. What can we do? Let's do sort of a ratio of population. This population ratio, and this was really put in at the very beginning when they knew there was going to be a lot of uncertainty. They're still in here, and sort of the fight, the debate here, it was, what do we get to include in this formula? Is it so what FTB normally wants to see is California over total US population. But then you got to take into consideration the markets and sales that a company might have outside of the US. So, but yet if you have, $10 of sales to China, you don't get the full China population in your denominator, which is one thing FTB wanted to make sure you couldn't do. So you have to have some sort of substantial basis, substantial presence, material presence outside the US in order to use a non-US. So these are proposed regs, and it's good to at least see where FTB is heading. They have some special rules to try and make it simpler. So if it relates to real property, services relating to real property would be in California if real property's there. Same with tangible personal property. Services that relate to intangible properties, where the intangible property is used. That's not always easy to figure out. This rule about intangibles, and we'll get into it a little bit later, it kind of assumes, and this is sort of where it started, got its birth, if you will, with royalties. And I use the example of Jeffrey the giraffe in this Toys R Us case from many moons ago, where they were using the royalty, they were using the trademark Jeffrey the giraffe, and that was used in the state of South Carolina. And South Carolina argued, and now the states kind of have rules to say, income relating to that is sourced to the state. But then intangibles cover more than these sort of trademark type things, and there's where there's some difficulties. This will be an interesting one. Services related to individuals will be sourced to the location of the individual at the time the services are performed. That could provide some interesting debates. What does that mean related to individuals? What if the individual is an employee? Lots of questions there. More presumptions. Again, billing address is something FTB does not want to use. Seems kind of strange to not want to expand this more. I would argue they should be using billing address more to make it easier, not necessarily all the time, but more. Here are a lot of there's a lot of new examples that they put in the proposed regs, and you can see them here. I'm not going to go through and discuss all of these. Asset management, service fees, they're really just looking through when you're talking about a structure with, say, multiple LLCs. They want to go all the way to the beneficial owner and source any income, that any asset management service fees, to where the ultimate beneficial owner is. These are more proposed regs. I'm going to kind of skip over the proposed regs. Sales of intangible property, to the extent the property is used in the state. Now the reg breaks up intangible property into here's a licensing of intangible property. That's kind of what I was talking about with the Jeffrey situation. There's also complete transfer of all rights in intangible property. So if you sell a patent or something, you no longer maintain ownership. The rules are a little bit different, as well as marketable securities and interest income. So going to the complete transfer cascading rules. Sales from intangible property complete transfers. The current rules look to where was the property used at the time of sale. So they're looking at the 12 months before the sale. So maybe you created some IP, where have you used that before it's sold? The proposed regulations look to change this, and they want to use where is it going to be used? Where will it be used by the purchaser? And this is like one of those examples where I was talking about, hey, these market-based sourcing rules could result in no filing obligation, or a filing obligation and you pay 100% of your income. If you imagine an out-of-state company creates some IP that it's used wherever it is, and it sells it to someone in California who's going to use it in California. Now, wait a minute, it will be used by the purchaser. That's 100% California. Whereas, was used in the state before the sale, none in California. Special rules for entity interest, dividends, and goodwill. So they use this look-through approach for entities. They'll kind of look at what is the entity's apportionment, and there's special rules depending on the type of entity. What it's mostly intangible property, or is it mostly real or tangible, to figure out what percentage of any sale of an entity interest would be apportioned to California. And then you can reasonably approximate as well. And then ultimately, if you can't do any of that, you can use the billing address of the purchaser. FTB doesn't like that. So, but they may, it depends on the situation, but usually the fight is in reasonable approximation. Okay, so then the asset test. So if that doesn't work, if you don't have the information, and this is a very rare, unusual situation where if you sell an entity that you don't have control over, but somehow that's still part of business income, because you don't apportion non-business income, which is a totally separate discussion. But an example of, like, if you have a minority interest in a business that has nothing to do with your business and you sell it, that's usually going to produce non-business income. It doesn't involve apportionment. It gets directly allocated. But if, say, you own a minority interest in a company that you use in a way to, like, say, get, preferred pricing or materials or supplies, so you could have a minority interest in something like that, or somehow it's used in your regular trader business, then these would apply. But if you don't have the underlying information, perhaps you're too small of an interest to be able to get it, commercial domicile. So licensing, this is kind of what I was explaining with the Jeffrey the giraffe scenario, and that would be a marketing intangible. And the general rules the regulations have now, and their proposed changes aren't huge, is so if it's a marketing intangible like Jeffrey the giraffe, we're going to look through your customer to the customer's customer. Ultimately, where is this thing existing and creating income? Non-marketing intangibles, and that would be something more like a patent or a copyright. The regulations don't use this sort of look-through rule and look to the direct customer. Okay. These slides are pretty exhaustive as far as what these regulations and proposed regulations are going to do. Marketable securities. These are generally to the domicile of the owner. They use billing address. Interest is kind of similar. Banks don't. There's some chief counsel rulings here I'm not going to go through. They're important for this reason. They've been withdrawn, these, and they've been withdrawn by this one, FTB Legal Ruling 2022-1. I'm going to go sort of quickly through what these other ones did. And the main thing was this healthcare plan service providers income and how they used the look-through rule in this 2022-1 with the exact same facts in the earlier rulings in 2017. They said, well, okay, so here's the scenario. Health plan has insured people, and then they hire a company to get the prescriptions out and transmitted and whatnot. So there's this company, and it's like, hey, how do we apportion that income? And the first ruling said, well, let's look at the health plan, the health insurance company itself. Where are they located? Because that's where they would have done it if they didn't hire you. Well, they changed that in this 2022-1 to say, no, we're going to look through that. We're going to look to the individual customers of the health plan, the individuals receiving healthcare. So this changes quite a bit. And this is going to be retroactive. So there's a lot of things for people who do business to business dealings might want to look because of the retroactivity. Perhaps they overpaid, or perhaps there's some exposure going back into open years. FTB has said that they're going to give some penalty relief for this, but there is nexus implications. And the one thing they're not giving penalty relief on is failure to file. So if this ruling somehow gets you into economic nexus land and you didn't file, but the old rules, you didn't have to, well, at least from what they've said, you're not going to get penalty relief for that. I would certainly argue otherwise, though. Again, this is FTB really not liking this business situs rule that I'd mentioned earlier when I was discussing the Metropolis case, 17952. So ordinarily 17952, if you have just the base case of an individual non-resident who owns an interest in a partnership, and that partnership's doing business in California, the non-resident just sells the interest, that is governed by 17952, and the gain is sourced to the residency of the individual. Again, FTV doesn't like this one, that, you know, it's the law, but now they've come out with this legal ruling saying, okay, well, not so fast, because if you have hot assets if the partnership has hot assets, then there's a special rule under feds that apply gain at the ordinary rates instead of capital gains for sale of partnership interest. Hot assets would be like recapture on property that's depreciated, as well as appreciated inventory. So they're saying, hey, you know what, the 17952 sourcing to the domicile applies, but not to the hot assets. We need to apply separate rules based on those hot assets. Where's the sale of tangible personal property? Maybe that's in California. So sort of complicated things for those non-residents. This is a kind of a important case, and it sort of reflects how broadly these rules reach. Mr. Binley, and I've gotten tons of questions from people on this Binley case, of worry and consternation. So this fellow just was a screenwriter. He was in Arizona. He wrote screenplays for a California producer, didn't leave Arizona. You know, it was all sent electronically. He got a 1099 because he's a sole proprietor. He got a 1099 from the screenwriting company. And California said, hey, you got to file a California tax return because you are conducting a unitary trader business, even though you're just sitting there in Arizona, never leaving that. The fact that you are providing a screenplay to someone in California makes you a unitary trader business that is being conducted in multiple states, in Arizona and California. And as a result, you have to use all these sourcing rules, the market-based sourcing rules, where's the benefit of the service, and pay California that amount. There was an appeal on this exact issue before, appeal of Larson, which was non-precedential, that came out the exact opposite way. They said there's no unitary trader business being conducted in California as a result of this service outside the state, but Binley is precedential and went the other way. So for the sole proprietors out there who have clients in California or are going to be getting a 1099, this is a big hot issue. And with that, I think we have finished, and happy to address any questions anyone might have.
If anybody has any questions, they can go ahead and put them in the chat. No, we're good.